Hello everyone. We'll wait for everyone to trickle in, get all set up and ready for today's webinar. So I'll give you all a couple of minutes. Feel free to use the chat box or the Q&A box as well while we're waiting for everyone just to log in and get set up. Feel free to let us know where you are joining from today. Obviously, we've got people on today's webinar from across the globe, so it would be great to know where everyone else is joining from: US, UK, Europe, APAC. Yeah, so feel free to share in the chat box. It'd be great to know where everyone is from.
Quite a nice mix. Lots of US, lots of Europe,
Australia.
Yeah.
Oh,
hello.
Madrid. Yeah, we've got a lot of different countries here. It's great to see.
Just saw someone from my hometown, Montreal, Quebec.
Right. So I'm just going to kick off while we still wait for a few people to trickle in. So welcome to today's webinar, the true cost of non-compliance, what you need to understand about personal liability. My name is Emma Skinner and I am the marketing executive here at ClauseMatch. I am just going to walk you through some of the housekeeping items in today's panel discussion before we begin. So just so you know, all participants except the panelists will be muted. If you do have any questions, as mentioned, please put them in the Q&A box and they may be addressed at the end of the webinar. And lastly, just to let you all know, the slides and a recording of today's session will be sent to you all tomorrow via email. And then just want to share a little bit about ClauseMatch and what we are. So we're an award-winning regulatory technology company and we help companies automate their compliance processes. We support organisations across the board, from large enterprises like Barclays and BlackRock to fintechs and smaller organisations such as PensionBee and Griffin. We do have offices from across the globe, so in the US, the UK, even in Singapore, and we also support clients from over 65 countries. That is just a little bit about us, ClauseMatch, and so with that I would like to introduce you to today's moderator, Claudia, and she is an account executive here at ClauseMatch.
Hello everyone, and thank you for joining us today. I will be moderating this wonderful panel that you see to the right of my image. I've been with ClauseMatch a little over a year now in a very client-facing role. So excited to get into the very, we'll say, hot topic of personal liability and compliance right now. And I'd just like to start by quickly introducing the panelists. So I'll ask them each to quickly give a little synopsis of themselves, and in asking the question and in answering that, to also ask a kind of miniature question, but how did you get into compliance? And the question to answer is, did compliance choose you or did you choose compliance? So Zeke, I see you smiling, and we'll start off with you.
Sure. I fell into this career 100%, and this sidetrack has carried on since then. Started out as a lawyer and then as a forensic accountant with PwC and with KPMG. After that, I became chief compliance officer at a Norwegian multinational called Yara, helped them through a multi-jurisdictional corruption scandal, and then became chief compliance officer at Volvo Group. After that, I've set up my own firm. So for the past 4 years, I've been running North Star Compliance, based out of the UK. I live in Edinburgh, but clients all across Europe, North America.
Thanks for that, Tom. I'll move over to you.
Sure. My name is Tom Fox. I also fell into compliance. I became a general counsel at a company in 2007 that had sustained the largest FCPA fine in the history of the world ever at that time, $26 million, not even in the top 30 anymore. But at that time, you did your remediation after you had settled your enforcement action, unlike now. And so I was part of the new management team that came in, and from that experience, I learned how to design, create, and implement a best practices compliance program with monitor oversight as well as DOJ oversight. So that's how I learned about compliance. The company ended up being sold and my job went away. So I decided in 2010 to go out on my own and be the nuts and bolts guy. So I started practicing what I had learned in my prior experience of design, implementation, and creation of compliance programs. And really everything has flowed from that forward today.
Amazing. Thank you. Christy?
Hi, I'm Christy Grant-Hart. I am the CEO at Spark Compliance Consulting. I too, I fell into compliance, but primarily because when I started at the big law firm at Gibson Dunn, I wanted someone to pay me to travel. And so FCPA seemed like a really good route there. And it was. I ended up in London for 9 years, back now south of Los Angeles near Laguna Beach. I also went from private practice in-house, first as the director of compliance for Europe, the Middle East, and Africa at Carlson Wagonly Travel, and ultimately as the chief compliance officer at the joint venture of Paramount and Universal in 65 countries. So very excited to be with this esteemed panel. Thank you.
Thanks for that, Christy. And last but not least, James.
Hi there. Yes, I'm James Fairclough, and I'm the Compliance Officer and MLRO for LHCM. You'll be forgiven for not recognising LHCM as a household name. We're a new entrant to the broker-dealer space in the UK, and an FCA-regulated investment firm. So as an executive director of the firm as well, my role encompasses 3 FCA-designated senior management functions, which are SMF 3, 16, and 17, and I've been doing these for about a year now. Yes, it's similar to everyone else. I fell into compliance. I was very much involved in operations in a previous life, and always very keen on process improvement and design. So those skills have been a good transfer into compliance and all the remediation exercises I get involved in.
Appreciate that, and I'll share a little tidbit about James and I. When I heard that we were doing this webinar and the title of it, I went to our marketing director right away and I said, I know someone that we absolutely have to have on this panel, because when James and I first met, our first conversation, I asked, why are you looking at regulatory technology solutions? What's really on the priority level for you? And his immediate response was, well, I need to stay out of an orange jumpsuit, and we need to make sure we have the right controls and processes in place to do so. And that made me chuckle. So James, appreciate you joining on with us today. And without further ado, let's get started into the content. So ultimately, we've broken up the webinar into 4 sections. We will do our very best to get through them all, but time permitting, we may or may not get the full extent of the 4th bucket. But ultimately, we will be looking at topic number 1, lessons learned from recent liability charges against CCOs. Section 2, regulatory changes that are increasing personal liability risks for compliance professionals. Thirdly, developing a robust and foolproof risk and compliance governance. And lastly, how technology can play a role in mitigating liability risks. So while obviously compliance as a whole has lots of different factors in terms of non-compliance and liabilities, we're going to be focusing primarily on personal liability today. Not to say that reputational and financial damage is less important or missed revenue growth opportunities, but where we really wanted to spend our energy and efforts is in this first bucket. So emphasis on really maintaining that chief compliance officer accountability for non-compliance and seeing how this can result in the corresponding consequences. So I think we should move on to the next part. Perfect, thank you. This is part one, lessons learned. So for the first question, this is going to be coming to you, Christy. Looking back at 2022, did any of the liability charges brought against CCOs surprise you?
I mean, I think that they're always surprising in some ways, right? The minute you get the word compliance officer and charged, it's a very charged statement, frankly. I think if you actually look at what happened in the cases where it actually occurred, what you see is a pattern of people who had compliance officer and executive roles. And so I think that that's really critically important when we look at the actual experience of people who've had this happen to them. And when you look at the way that it's written up in the charging documents or in their settlements, there's some pretty egregious conduct and just absolutely totally paying no attention whatsoever. So I think that we need to temper that fear with the realization that if you're doing your job, you probably will be okay. But that it's definitely something to concern ourselves with, regardless, that these things are in fact happening.
Absolutely. And to kind of dig into that a little bit further, Zeke, I'm going to come to you for this. What can CCOs do to prevent personal liability cases?
Well, I think, the main thing you can do is do your job diligently. I think we should touch on one of the recent cases, which was in the US, which was Activision. And the reason that case was brought, and you can read about this online and in great detail, one of the reasons that case was brought was because the risk disclosures in the financial statements were not properly managed. And so I think that's a small side note for chief compliance officers to be very careful about what risk disclosures we're making in the financial statements. And it may seem like a very boring task at that point in time, but it's something really to take great care of. So other than doing their jobs as well as possible, I think CCOs need to really keep a high awareness of this personal liability landscape. One of the challenges that we're facing as a profession is the need for greater kind of peer-to-peer contact and having those interactions and discussions amongst each other to make sure that we're keeping up with best practices, which is frankly really hard when you're the only compliance officer in a firm or part of a very small team. And part of that peer interaction should be voicing concerns that we have about developments on the regulatory space. So if we feel like the liability charges being brought against CCOs are in any way unfair or unjust, I think that would need to be voiced. I don't happen to have that point of view myself, but it's certainly important that we speak up so that we get good legislation and good enforcement.
Absolutely. And are there any channels in which you would recommend being able to use that voice and to speak up within?
Sure. I think if you go to your local bar association or your local professional body, I'm a member of the Institute of Chartered Accountants for England and Wales. And that's a great forum for getting together and discussing things. But in past past lives, I have also just reached out directly to companies, even with certain safeguards, competitors, just to get that point of view on how the law is developing.
That's great, thank you. And Tom, I'm going to come to you for the last question, and this is really looking at this year, but what compliance violations do you see chief compliance officers being held accountable for?
Well, it's interesting because I've always found in regulated industries, the rules are clear, and that when CCOs are held accountable, as Christy mentioned, it's either very egregious facts or they're involved in the violations themselves. But now we've seen literally over the past several months, a change in non-regulated industries that I think is going to be as big or bigger impact. It began with the U.S. Department of Justice announcing the requirement for CCO certification of completions of deferred prosecution agreements and compliance programs for those companies which had sustained a deferred prosecution agreement. That was earlier in 2022. In January of 2023, in perhaps an equally or even larger importance, a decision came from the Delaware Court of Chancery which put a duty of oversight on corporate executives, specifically including chief compliance officers. So now chief compliance officers can be held liable personally in shareholder actions for failure of oversight. And it's basically around either not putting in an information system or ignoring red flags. And if I could build on what Ezekiel said about Activision, that action was a Securities and Exchange Commission action against Activision for failing to provide material information in the form of discrimination and harassment claims. Now, and that case had some extraordinarily bad facts, like the CCO tweeting and sending out an email that the whistleblower claims were all false, and there were people making up these claims. Well, now they've had to put in a 10K, or excuse me, a Q filing. Those claims were actually true. So when you have a CCO who puts out that kind of information, they either should have investigated the claims beforehand, or if there were whistleblower complaints and true red flags were raised, they ignored them. A CCO could now be held personally liable under this new Delaware Court of Chancery decision. So we have non-regulated industries, oversight from the Department of Justice and the court system in the United States, sort of leapfrogging the CCO liability by regulation we'd seen in regulated industries. So it seems to be expanding. I don't know what exactly the parameters are yet, because some of these new DOJ and court case are so new, but I certainly see it as a possibility for expansion going forward.
That's really interesting, like the responsibilities that will be enacted on the non-regulated industries and what those will look like. So that's a point I hadn't thought of. That's an interesting topic of conversation. I feel like I can get into a dark hole with. Is there anyone else on the panel that has any other comments on this part of the presentation today?
Yeah, I do. I think that one of the most important things, like going back to that prevention, right? I think documentation of when things don't go your way, when somebody tells you no, when you're not given the resources, when you are overruled on something you feel strongly about. I think if you can make documentation of what happened, what you requested, what the outcomes were, that if you are ever in this kind of situation, that you can show contemporaneous notes about what was going on, and really just document that you were responsible, responsive, doing your job, trying your best. Because I think the existential fear comes from the idea that we don't always have control, or frequently don't have control at all, over what the business is actually doing. We're advising more than anything. And so, unless we want to go to the board and say, this is all terrible, we need to fix it. And even then, maybe it's not going to get fixed. So I think there is a place for self-protection, and the documentation and contemporaneous notes are really helpful for that.
Having evidencing just always available, that's a very valuable point as well. Thanks for that add-in. If we can move on to the next section, we're going to be looking at regulatory changes that are increasing personal liability for compliance professionals. So a few questions to go through here. The first, before I get into that, just wanted to talk a little bit through, sorry, you can bring that slide back. Essentially what we're trying to demonstrate here is that from a regulatory standpoint, there are a number of regulations across the globe that obviously will impact this conversation differently depending on where you're sitting. So I won't get into each and every one of these buckets, but I just will preface that the next slide's really going to talk primarily around the United States and the EMEA region here. So if we can move forward there. My first question is coming to Christy once again, and it's in regards to the DOJ's new CCO certification, which was brought up earlier. And will that help stop personal liability?
No. I think this is my answer to that question. First of all, I think it's really important to recognize just how narrow this is, right? As Tom was saying, this is really at the end of deferred prosecution agreements, and it's not just the CCO, it's the CEO, right? But there are a whole parade of horribles in terms of what does this actually mean? I mean, if your CEO is sitting there telling you, yeah, it's good enough, sign, are you committing perjury? If you say you won't sign, are you going to be fired immediately? And what if you come into the job halfway through and you don't like what's going on? And now there's so many different ways that this can go wrong. I think that they are trying to do something in a positive way that I think it will be interesting to see how it actually occurs. In terms of encouraging companies to scapegoat their employees, I mean, ultimately you're asking people to take responsibility for their work and for the company. Two specific individuals, your CEO and your CCO. I think it will be interesting to see if this becomes any kind of best practice to certify from, say, the board asking the CEO or the CCO if they think they have a good enough program. But frankly, I don't know. I think that the onus, the actual experience of this in real life, if you're that CCO, could be really uncomfortable and frankly, not one I would want to have to deal with.
That's awesome. And we're getting some questions in the chat box that are pertinent to this, so I'm just going to ask them now as opposed to kind of wait to the end. One that came up was, what does this mean in an organization where there is a designated compliance officer, but they're not an executive level? So they're a CEO as opposed to a CCO. Does that change anything?
It's an open question at this point, but I think what it means is CCOs are going to be given that status, whether they like it or not, eventually.
I would agree. And to that point, Tom, so if we stick with you on the second question, you mentioned earlier, you know, regulated industries, the rules are clear in terms of how you need to abide. But what are your thoughts on the SEC's, we say unwillingness, but the fact that they haven't necessarily implemented or showcased a very clear CCO liability framework yet?
I have advocated for years that the SEC has implemented the CCO liability framework, and it's very clear. It's clear to me. That is willful blindness, actual knowledge, and participation. If it's one of those three things, and to me, that's as clear as a framework that is needed. I don't see the need for any additional frameworks. People who want specific points, I just don't think that's needed. And so I've always felt like the current framework in place that the SEC uses is good enough. So that's my position on that.
Fair enough. I think a lot of people look at it as if we're in a place of good enough, how can we make it, you know, great enough in that sense? And what could we add? What could we contribute to solidify it in that sense?
If I can,
I just feel like it is filled out.
I think that if you look at after the Kirkpatrick decision came out, that Commissioner Pierce published essentially here's why we made the decisions that we did, probably in response to, as Zeke was talking about, the pressure of, well, why did you make this choice? How did you make this decision? And they used the New York City bar framework, and they went through it independently, every single one of those pieces that the New York City bar looks at. And I thought that was just very strange to say, we're absolutely not endorsing any kind of framework, except here is our decision based on this framework and how you can look at it. So I suppose if you really want to understand it or really want to put something, I think Tom is absolutely right with his distillation of that. But I think that, yeah, they haven't adopted it, but they've clearly used it. So if you want to, that's probably the best way to think about it.
Thanks, Christy. And now if we kind of transition into the UK EMEA region, James, I'm going to be coming to you for the SMCR question here, but how has the FCA's SMCR had an impact on a person's ability?
There's mixed views on it, to be honest. So some would say that there is success in terms of changing culture and things like that within organisations. However, others would say that that the sort of cases being raised against individuals aren't that significant, and either in quantity or success necessarily. So yeah, it's a real mixed bag, really. But I can give you a whistle-stop tour on SMCR for people who might be less familiar about it.
Yeah, you can maybe just give a quick, yeah.
Yeah. Okay. Yeah. So, I mean, essentially, yeah, this blueprint came out of the banking crisis and was the brainchild of UK politicians, and then ultimately implemented by the FCA and the Bank of England, the PRA, for dual regulated banks in 2016. More recently, in 2019, it's come to apply to most other firms, including my own. Yeah, it was aimed at increasing the accountability that was observed as one of the core reasons for why the banking crisis came around, and the misconduct that everyone saw. So we're looking at 7 years of this regime. As I said, yeah, there are some optimists that might suggest that that there have been cultural changes and things like that. But yeah, are the punitive cases really there to evidence that it is successful?
And to elaborate further, Zeke, if we were to look at other developments coming out of the UK and the EMEA region, what do those developments, if any, look like they could have an impact on personal liability?
Yeah, I think that's a really difficult question, and I think, you know, I can comment on this outside of the financial services sector, for example, for industrial companies, where we see lots of chatter about greater accountability of both corporates and senior executives, but it is painfully slow progress, and I think that's because we don't have that extrajudicial enforcement that the United States has seen in the past couple of decades. So progress is very slow on this side of the pond. And to give you the very short version, I don't think, you know, any of the progress really would affect the CCO liability, in my opinion. I think, in fact, if you even if you look at the US and the enforcement actions there, the vast majority of them don't impact CCOs in industrials. So here in Europe, if you read some of the legislation that's coming out, for example, if you read the preamble of the EU's Corporate Sustainability and Due Diligence Directive, and they seem to be despairing of the lack of progress on accountability. They're talking about having really played the nice guy for the past few years, but well, that's not worked. So we're going to regulate you a lot more heavily and get to some serious accountability. But still, that's a draft directive. I do think a seed was sown in the form of the UK Bribery Act, so 2010, and came into force in 2011. And this idea of the failure to prevent was very impactful on corporates. So there's a seed sown there, and you can see that the willingness to expand that idea much further into anti-money laundering, into financial integrity. So, you know, last summer we had a paper issued by the UK Law Commission, and in that paper there are several options for greater corporate criminal liability. One of which is an expansion of the failure to prevent, and I think that is proving very popular with politicians here. So on balance, yeah, I think we're moving into these additional areas of accountability, but it's pretty slow progress unless you're in a regulated industry, in my view.
Fair enough, and granted that we're not talking within the financial services space, so very understandable there. Curious, James, if within financial services you're seeing anything specific in terms of developments?
Well, probably to address some of the critics, there has been an uptick in activity from the FCA in particular in the last quarter of last year, and yes, so, a few cases particularly relevant to my area of the industry. For personal and corporate liability charges being raised. So whether that is a shift from the FCA to address those critics, and we see more of these, remains to be seen.
Perfect, thank you so much. I think we'll wrap up section 2, and we'll now get into part 3, where we'll look at developing a robust and foolproof risk and compliance governance. So Christy, coming to you. How can CCOs protect themselves while in the role if they see that things are going badly or people aren't listening to them?
So I apparently gave my own advice too early. Document, right? Write things down. Every once in a while, I get an email from someone who says, my manager's horrible, the fraud here is rampant, the CEO is awful, what do I do? And my answer is typically, well, you might want to think about quitting, because honestly, at some point, it gets too far to be a tenable situation. So I do think we need to at least have that as in our mind, like we don't actually have to fix everything. We can in fact leave if it's not working. But I do think that there are opportunities to try to just continue that influence, right? Help people to understand what the stakes are, to try to appeal to different kinds of motivations, whether somebody is, motivated to try to do the right thing. There's some people that are motivated that way. Other people just need to be slammed with fear and to hear about what can go wrong, maybe how we can help them do better in the business with compliance and ethics at the focus of it. But just in terms of protection, I don't think there's anything better than documentation and always knowing that you are, I don't think there are very many CCOs that are in indentured servitude. So if that's not the case, you can actually think about leaving and let that be an option.
Yeah, and although what I'm going to say now doesn't necessarily have to do with protection, but one thing I'll share with the group is I read an article, I think it was about 2 weeks ago at this point. The headline kind of caught my attention because it was about should essentially executive compliance officers or compliance officers sitting really at the executive level, should they have compensation or bonuses tied to a strong year in compliance for their organization? And I'll just kind of put that out there with the group. I know this is a little bit left field right now, but I did think that was an interesting point to touch on. Do you think that would help in preventing to a certain extent of things going wrong?
So that has been a part of the 10 hallmarks, now the hallmarks of an effective compliance program for some time. Certainly the incentive component can be factored into a senior executive's discretionary bonus, stock options, or other compensation. What the Department of Justice told us in 2022 was that they expect clawback provisions written into senior executives' contracts, which would mandate a literally recoupment or clawing back of compensation paid out to executives where it turned out that they were either involved or willfully blind or consciously indifferent to bribery and corruption. From the SEC perspective, the example of Stephen Easterbrook with McDonald's was one case where a company clawed back compensation, which was paid to the senior executive upon his departure. That case was unique because the compensation paid upon departure was clawed back later when additional facts came to light of Easterbrook lying to McDonald's internal investigation about other incidents which had caused his termination. So both the incentive component and the disincentive or the clawback component are now something that the DOJ expects literally every company to have in place.
Thank you. And do we know if there's something similar, Zeke, James, in the UK and in Europe?
Yep, this is a very similar story in the UK. Yeah, the FCA is constantly going at various remuneration policies for companies from various aspects, not just conduct, but relating to sort of systemic risk and things like that. And yeah, just firms taking excessive risk in general. So a very familiar story in the UK, I'd say.
And we'll use this as a segue to kind of dovetail into this next question, but I'll stick with you on this, James. But how can organizations develop a robust risk and compliance governance?
Well, I mean, for me, and with the FCA as my regulator, the FCA is very, very prescriptive in terms of how this SMCR framework works, and it's essentially about shifting the balance in terms of who's performing the work to assess individuals as suitable to work in the industry. So the FCA will continue to assess the very top level of the pyramid, the senior managers, So they've got their own accountability and conduct rules that they must follow. Where before there used to be a case of pretty much everyone in the organisation would be some sort of control function in one way or another. They've really sought to limit that population more, and firms have been given the responsibility now to assess those individuals as fit and proper. And then outside of that, you've got the bottom level of the pyramid, which is the vast population of employees, which runs to everyone except for like security guards and cleaners, essentially, who all have to follow these conduct rules. So what this means for organisations regulated by the FCA is that there are a whole host of top to bottom requirements for organisations to implement, and then at the top, the senior managers who are being paid the premium to do the role that they're in. That there are some things that are ultimately part of the organisation they're responsible for, but there are other activities that they should definitely be responsible for to themselves to protect themselves. So the senior manager conduct rules are to ensure that senior managers are aware of what's going on in their area of responsibility and that it's controlled effectively. That things are to the required standards and meeting the regulatory framework. And very importantly, that where they delegate any aspects of their job, of their responsibility, this could either be to someone directly in their reporting line, or it could be an outsourcing or third-party relationship, that they are still accountable for that. So there's some obvious things that organisations can look to keep on top of, which are their documentation, org charts that show all of these clear lines of delegation and leadership. We've got a concept of statements of responsibility, where the FCA expects a certain number of prescribed responsibilities to be met by firms, but then for any other responsibilities that senior managers have, that these are clearly stated in statements of responsibility. So again, if something goes wrong, the FCA can look at exactly who is responsible for that aspect and go and ask them questions about it. There's an obvious need to maintain training for everyone, especially with this sort of top to bottom requirement throughout an organisation. But then senior managers will probably need to look at their own training requirements outside of the corporate provided training, and also do read across of cases that they see as relevant occurring in the industry and ones that they might want to avoid within their own organisation. There's literally a whole framework. I can recommend reading from TISA, who provides a guide to reasonable steps under the FCA as essential reading for anyone that wants to know more about this. But hopefully that's covered some of the key topics.
It has, and we've actually, although we were going to skip through it in this presentation, we've included a screenshot of those reasonable steps in the presentation, so anyone watching will get that in the recording as well. But thank you for the recommendation, James. We also had a question. It was answered in the chat, but the question was, can CCOs take professional indemnity insurance against personal liability? To which Tom responded, yes, they can. So anyone else who had the same question in their mind, the answer is yes. We've got a little bit more time, actually. If we can go back to that slide with the questions, I'm going to also kind of throw out a question to the group, and it's one in which maybe Zeke, maybe we could start with you here, in which you've worked at really large organizations and have had to step into these roles, where I'm curious to know, when you're working within an enterprise or a large organization and you get into a role of chief compliance officer and you recognize that maybe things aren't as great as they could be and need to make enhancements, kind of what advice would you give for someone in that situation in terms of step 1, step 2, step 3, or what are the most important elements to attack first, and then move on accordingly?
Yeah, so I think just as a preface to this answer, I mean, it depends what stage your organization is at in terms of its problems. When I took over at Yara, there was already a huge media outbreak of stories on the topic of corruption in the company. Arrests had been made of very, very senior executives. And it wasn't long before we had both a settlement from the company. We paid $50 million to settle the case, as well as the conviction in the court of first instance of 4 members of the executive management, including the former CEO, later acquitted, of course. So it depends on the stage of the enforcement at which you're at. Now, if you're early on and you see things are going wrong and you're not yet into any kind of enforcement action, I think that reduces your leverage, and you've got mostly a problem of buy-in at that point to say, look, I recognize things need to change, and these are the steps that I would propose. I think there you need an ally or allies within the board. You certainly need to have that direct access to the board in order to have that conversation. So without those fundamentals, as Christy mentioned earlier, you might want to consider your position otherwise. If you're already into an enforcement action or these strong sort of public actions, I think the leverage is going to be there. And your job is going to be to run as fast as possible. Anyone on this panel will probably already know exactly where the bodies are buried in terms of what you need to do as the Chief Compliance Officer. Certainly going after third parties, joint ventures, anywhere where you don't have full control, full insight. And I think that what's often missed in that frame of where you don't have full insight are your own legal entities, which are not fully integrated. They might be kind of standing alone. You might not have decided whether to integrate them or sell them on. You need to get inside there, because otherwise you're going to be held liable as a company. Those are just some initial thoughts on that question.
Yeah, no, that's great. Does anyone else from the panel have anything to add on that?
I would say that you should assess your risks and then put a risk management strategy in place to manage those risks, so that if you come in to an organization and, as you said, it's perhaps the program is not as robust as you had been led to believe, I think if you assess the risks to see where those risks are, what the government expects is that you have a plan in place and you be executing on that plan. Let me emphasize, you do not have to do everything at once. What you have to do is execute on your plan, monitor whatever your strategy is you put in place and update as appropriate, and then go to the next issue. So that if you have a plan and you execute on that plan and something happens and the regulators come to you, or you self-disclose to the regulators, you can say, yes, we picked it up. This is how it happened. This is the plan we have in place to remedy it. This is the plan we have in place to make sure it doesn't happen again. So it's really, if you find yourself in that position, figure out what the highest risks are and then move to manage those risks, monitor your risk management strategy, and update as appropriate in a logical manner.
And to Christy's point, taking that exact mindset and documenting every step of that way, making sure that you're identifying those risks and your plan is not in your head, that's really something that is concrete and evidenceable. So appreciates everyone's thoughts on this.
Just to add to that, I think that, after about 5 years of being a Chief Compliance Officer, I wrote an article that, is on LinkedIn now. And essentially, I was reflecting on the fact that I'd started out with a very legal compliance mindset, and that if I could start over, I would actually put in place, at that point, I thought maybe I would put in place a human rights program, thereby kind of getting the same outcomes, but across a much broader risk spectrum. And I think that channel of thinking is really rich. If you go further down that road, you end up thinking about integrated risk management. You think about one definition of ESG, and really using that risk program to address corruption, data protection, sanctions and trade compliance, competition law, but also human rights issues and social and environmental issues. So very powerful area there, that often if we had a second bite at it, we might do it differently.
Yeah, having it as a holistic approach as opposed to a very kind of segmented or vertically distributed approach.
Right.
Thanks.
I think I'd like to add on to what Tom was saying, that the risk assessment piece. So at Spark Compliance, we frequently help companies that don't have a compliance program or that have barely started. And what I see frequently done incorrectly is that compliance officers tend to be a heck of a lot more comfortable with pushing out training or doing communications than they are with actually doing a risk assessment, because frequently that just feels hard and uncomfortable, and sometimes they have a mistaken idea that they don't want the risks written down if they're lawyers, or if they have a red, then that's bad and they can't, that's not a good thing to have. So I think that really trusting that risk assessment is the most important thing to start with, and creating a plan as opposed to simply doing some training and hoping that your investigations, keep you busy enough to not have to do the big hard thinking. I think it's beneficial to really say, no, I do need a risk-based approach that requires a risk assessment. I have to start there, even if it's uncomfortable.
Yeah, I agree. And that's, I think, a big part of where management comes in. It's shown time and time and again in studies that people are typically, they're proven to essentially rather at the status quo make no decision that will end up having no impact on anyone, even if it's not necessarily the right decision, more so than making a decision that they fear may have negative outcomes, or someone might see something wrong and that can be attributed back to them. So it's that mindset of like, I'd rather do nothing as opposed to do something. So that's a really interesting point, and I appreciate you sharing it from the other perspective of the smaller businesses that are just getting started in this space.
We should definitely all be aware of our biases. So yeah, I've heard people talk a lot about biases there already. And one of the cases that I saw last year in November was FCA action taken against Pello Capital Limited. So this was a corporate case, not an individual one. Yeah, so essentially there were various failings that were discovered at this firm over quite a short period, just a year in this one, where normally you're seeing investigations covering a longer period. It just seems like a total collapse of everything from governance to management information not being developed at all, risk management and controls framework, minimizing conflicts of interest, and monitoring of clients. So a complete sort of collapse of all of these things that these senior managers should have been aware of. And the FCA concluded that the remediation exercises would take about 12 to 18 months. However, Pello, the firm, had a much more ambitious time frame of 6 months for all of the actions. And on that basis, they just imploded even further and had to file for Chapter 11. So yeah, this just being realistic with your remediation exercises as well, and what you can actually achieve with the time and resources available. Definitely.
Thanks, James. I'm glad we got everyone to speak on this. This was a big part of the presentation today. And for the sake of time, I'm going to move us forward to the next section just so we can get it all in and leave a bit of time for Q&A towards the end. If anyone wants to take a screenshot, we got a bunch of requests in the chats. Feel free to do so. But again, you will have this slide as a part of the presentation when we send it following the demonstration. So if you want it, grab it now, but you'll get it later. Moving into the final chapter of today's webinar, how technology plays a pivotal role in mitigating liability risks at a corporate and individual level. Christy, I'm going to come to you on this, and I know the question is how technology plays a role in this, but I guess I'm going to even take it a further step back and say, question one, does technology play a role in helping reduce personal and corporate liability?
Yes, it absolutely does. It's unbelievably important, especially if you have a firm more than a few people. It really requires the ability to get to all those people, whether you're talking about training, whether you're talking about third-party review, whether you're talking about sanctions monitoring. Without technology, those things are extremely difficult. And when we're talking about that documentation piece, the audit trails that come from those pieces of technology, right? Yes, I was trained on anti-bribery on these 3 dates. Yes, I signed that attestation for the code of conduct. Yes, we did third-party due diligence. And just because Sheila quit the firm and it was in her email and now it's gone versus it's all in a singular system with an audit trail, all those things make massive differences when you're trying to prove what you've done and also to run a program at all. I mean, any larger company, I mean, the first thing we tell them, again, when they say, well, what do we do now? Is that you need a hotline, you need investigations capacity to chase, to track what you're doing. I mean, ultimately, you probably need training software. You probably need third-party due diligence and sanctions management software. In any kind of company of any real size is going to need those things. And so I think without technology, it's basically impossible.
Fair enough. James, what are your thoughts on this?
I'm all about dashboards. There's some really clever dashboards that can be created with big data. So yeah, I'm very fortunate that I've got a whole host of developers at my fingertips, and when they're not busy implementing platform changes, I'm generally trying to get them to develop some sort of dashboard for me. Yeah, they're just a super way of getting exactly to the root of the issues that you want to look at and scrutinize. Make sure that the right people are alerted, and ultimately there's no excuse for people not to be aware of these things and keeping them in their crosshairs.
Mm. And Tom, what has your experience been with technologies in this space? And if you had to make a recommendation around not the technology itself, but as a business who's maybe getting started and needing to implement some of these solutions, which one should be kind of at the forefront of their priorities, and which one can stand to live a little bit longer without?
So once again, I would fall back on the your assessed risks. For your industry, your business, your customer base, your client base. What's your sales model? Do you use commission sales agents, or do you have in-house personnel? All of those questions. Are you selling to foreign governments? Are you selling to governments? Are you selling domestically? Are you selling internationally? Sort of all of those questions. And the thing I would like to emphasize is in 2016, the Securities and Exchange Commission, in an enforcement action, for the first time said you need to utilize data analytics on your sales. So this is not new. It's 2023. It's 7 years later. And so I would advocate having data analytics around your sales to see if there are any anomalies, which really brings up the one thing we haven't touched on, which is everything we have advocated for to protect the CCO and from the compliance perspective will improve business efficiency. And if you're not analyzing your sales, you're missing a huge opportunity just to see where are you selling, how are you selling, what's the best way to sell, who's the super salesman, or what's the best sales model to use. All of those things are things that a compliance officer can look at to see if there are anomalies, but more importantly, the business can use to make the business sales process more efficient, and at the end of the day, your company more manageable. So the things we've advocated throughout this podcast to protect a CCO and go a long way towards improving your overall business efficiency and your ROI. So that's maybe where I might start. And I just have to echo, Christy, the three most important things in any compliance program are the following: document, document, document.
I love that. And we're doing really well on time. We've gotten a few questions that I'm going to put out to the group. And one hits particularly close to home, and it has to do with essentially budget. So the person writes, technology has a lot to do with it. So when management does not make the budget for compliance tools, that puts personal liability at risk. My question, maybe Zeke, I'll frame this to you. What has been your experience in essentially getting the buy-in from the CFO or anyone in that senior management level who ultimately is going to need to approve spend on these sorts of technologies? What kind of toolkit can they bring forward to help make these purchases?
Yeah, so I think firstly, I would welcome any critical questions around procurement spend, because that's a part of the process that we should also be encouraging in the company more broadly. So, you know, if the CFO challenges, fine, we have to answer those questions. Generally, find a way. If the budget really isn't there, and you've argued for it and you've made a really great case, but the budget's still not there, okay, find a way. There are lots of ways to do this without, you know, extremely expensive technology and automation. You can go a little bit more manual if that's the way it needs to be. Depending on your business, you can actually, you know, go through a good deal of transactions yourself, certainly in an industrial context. So make your arguments, find a way to do it slowly at first. And I think once you've started demonstrating a bit of value, yeah, you can probably get the argument a little bit stronger and reinforced later on.
Definitely, especially I think it's a great question given just the economic climate as a whole right now, and we're seeing obviously budgets tighten up just in about every industry at this point. So it's definitely something that I can get on board with when you saying, you know, make it work in the time being and build a business case in the interim that proves value, and work with the reps at whatever organization you're working with. They're there to do so they can help you build out that business case with your collaboration. So
Right.
appreciate that. We had a specific question for Tom and Christy, and that is, given the importance of the risk analysis to crafting a compliance program, is benchmarking overrated or a potential trap for compliance officers?
Tom, I'm
I
waiting
will
to see who wants to answer it. Go ahead.
Go ahead, Christy.
Nope, yours.
I find them to be different tools. So they both serve different functions. They're both equally valuable, and I don't feel like it's a trap or something that a compliance officer should not do. You certainly would like to know what your peers might be doing, but you can benchmark against what the regulators say. So, for instance, you can take the hallmarks of an effective compliance program, you can match that up with the COSO internal controls framework, and you can benchmark where your entire compliance program from an internal controls perspective may have gaps. So benchmarking is a different tool. The risk assessment is, I would say, more dynamic in terms of what are my risks today in February 2023, because they may have been different than they were in December 2022. Over the past few years, we've seen as much change as any other point in time. So risk assessment is a little more dynamic, but benchmarking is a very valuable tool as well.
Yeah, the more you know about what others are doing, to a certain degree, it tells you what the regulators are going to be expecting, because what they see becomes best practice over time, right? So I think that understanding what others are doing and frankly, getting creative ideas. I mean, I don't know about all the people listening today, but part of why I watch webinars and participate in them is to find out what other companies are doing. So I think that kind of knowledge base is always useful, and I wouldn't shy away from getting it if you can.
Awesome. I think we can squeeze in one more question and then we will probably be out of time. But again, I'll just put it out to the group, and it's when you are in a jurisdiction where regulation does not protect the CCO and the management ignores CCO advice that leads to infractions, what do we do?
I'm going to let you lead on that one, Christy.
Document. Document, think about quitting. Honestly, I think, look, we have to protect ourselves, right? Ultimately, this is about self-preservation and doing our job well. So if you're totally unable to do your job well, that threatens your self-preservation, and it also threatens your self-esteem and you're feeling good about what you do. So there are other opportunities that exist in the world. But for the most part, do keep in mind, maybe going back to the very beginning, the actual liability suits are for people who genuinely ignored everything, didn't do their jobs, gave into conflicts of interest, they're really egregious. So it's much more to me about doing your job the best you can and documenting that than being overly concerned with personal liability.
Thanks.
Yeah, I'd echo that. Totally agree. Yeah, just everything you can do to cover yourself as well. Keep copies of emails that show you raising these concerns. Use the governance structures to raise these concerns, and make sure that things are recorded in the minutes accurately. These are the sorts of things that that you can sort of weaponize back in these circumstances to sort of protect yourself. And at the end of the day, if none of that's in place either, then yeah, as Christy says, it's time to start looking for new jobs on LinkedIn.
Thanks, James. That will bring us to the end of the hour on the know. So thank you everyone for being here. Great engagement, and thank you for putting in your questions. You will be receiving this recording, if I'm not mistaken, today, but maybe tomorrow, in one of the 2 days. And otherwise, if you have any additional questions or want to know more about any of the panelists, feel free to reach out. We're all happy to connect on LinkedIn and answer any follow-up questions you may have.
Thank you,
Thank you so much.
Thanks, guys.
Bye, everybody.
Thank you all.
Thank you. Bye.